Good morning. Welcome to IntelliCredit's webinar on today's loan review for today's credit risk. We'd like to share about 5 general perspectives with you about what we think would merit some kind of refocusing and rethinking of loan review priorities given the uncertainty of today's credit landscape. I'm David Ruffin, principal of IntelliCredit. Been around the banking industry a few years, but certainly one of my clear pleasures has been being part of a founding group to form IntelliCredit in 2019, and largely it's around doing very deeply experienced loan review, deliverable though enhanced significantly by technology. I'm proud to be joined today in the presentation by also a founding member of our management team, David Littleton. He is the director of data analytics, product management at IntelliCredit, quite focused also on the development of enhancements for the IntelliCredit product, which we'll talk about it a little bit at the conclusion of today. So, David, again, glad to have you with us.
Yeah, thanks, David. And David Ruffin will be doing most of the talking today, and I'll be monitoring the chat and participating in certain aspects. So feel more than comfortable to reach out with questions, and we'll respond accordingly. So a little bit about us at QuickRate. QuickRate is obviously a funding source that's been around since the 80s, and Quick Analytics is a little bit of a newer tool based on publicly available bank data that helps you do CECL and credit stress test and peer analysis. But then IntelliCredit, formed in 2019, is focused on specific loan portfolio data from banks and focused on credit risk management and loan reviews. So, David, can you tell us a little bit first about what some credit trends you're seeing today are telling us?
Yeah, and I think they are clearly giving us a little bit of concern after arguably a decade of very benign credit performance. Unfortunately, second quarter numbers for 2023 showed an earnings decline at the community bank level, which always sets the concern about, okay, where are we heading in terms of potential at risk with credit. Certainly, liquidity and deposit drains have dominated banking news in the last several months. It actually has shown up in terms of surveys by borrowing customers that they have significant fear of a credit crunch effectively developing because of this liquidity. But also, I think the reality of it is when you've lost this much deposit, as you can see here graphically, and again, all of these numbers are going to be focused on 10 billion and under assets, because our sister division, Quick Analytics, primarily focuses on that. If you add a lot of mega bank data in head, it kind of skews the narrative here. But as you can see, with all of this runoff in liquidity and deposits, of course, that was at the heart of some of the banking failures earlier this year. It has, again, created not only a sense of, concern by the borrowing customer, but also around, it also puts a focus on, okay, what are we doing relative to funding loans, and do we have to become even more careful about what loans we are funding? That obviously has spurred a rebound in the wholesale market of funding loans, significant increases shown in the last couple of quarters because of the drain off in all of the kind of the post-pandemic government money that was put into the system. But as you well know, too, that one of the issues with wholesale funding is that if you begin to have credit quality issues, you can be effectively put in the penalty box by regulators here. One of the things, too, that is interesting from second quarter data nationally is that the smaller banks' reserves are continuing to decline, and they have for several quarters now. Not so with the larger banks. They're pouring it on in terms of significant reserve add-ons in the last quarter, in particularly. It does beg the question of what do large banks know that smaller, less complex banks don't know. You see here graphically dispersed among the regions. As you can see, it's been kind of a flat to potentially some decline in reserves. The interesting thing here to me is that, and I didn't show this graph, is that in the Northeast banks, which is the green line at the bottom with the little triangle, they are actually on an aggregate basis significantly lower than the rest of the regions in terms of their reserves, but they also have some of the highest momentum of identified problems in the last couple of quarters. So again, these are basically smaller banks under $10 billion in assets showing a leveling off, or if not anything, declining reserves in the face of what the bigger banks seem to be sensing that they are adding reserves. There's certainly continuing pressures on NIMs because of the interest rates, and that's something, of course, your boards and management live with. And also efficiency ratios have declined in the last couple of quarters, particularly more pronounced at community banks. Perhaps this is overkill, but a noted economist said just last week that community bank economic sentiment is worse than dismal. Again, that may be hyped a bit, but certainly it does give us some sense of where momentum might be heading in credit, which is obviously what we're talking about today. Again, I've said this for a number of quarters now. I'm really concerned about overreaction by the regulatory community and the investor community upon first signs of stress. And I think that's going to put even more pressure on individual banks to kind of defend themselves on where their credit risk profile tends to be. Again, we'll talk about that a little bit later. Again, credit performance metrics are still good, but remember, this is driven largely by a call report or public data. And those of us in the credit management world understand that those horses are long out of the barn. If you're managing your credit risk strictly by a call report, the real art of credit risk management is understanding emerging credit risk that's percolating in those past risk grades, not the criticized classifieds. Loan demand is moderating and is clearly moderating after incredible 2 years of very robust loan growth at the community bank level. But this in and of itself has a little bit of a concern for us and will require some monitoring. Why I say this is, for those of us that were in banking for the financial crisis of the Great Recession, we know that we had a massive run-up in loan growth right before the bottom fell out in about 2008. And unfortunately, 2/3, arguably to 3/4 of the losses incurred by banks during the Great Recession were from loans that were generated 18 months prior to the advent of the Great Recession. As you see in this graph, you've also got the same type of velocity of growth recently. It's moderating somewhat, but again, we've got to keep an eye on what is that vintage, so to speak, of that recent loan growth at our portfolios. And I would certainly think that's important from a loan review perspective. Again, you'll see the amount of growth here, but again, it's been empirically proven through the travails of the financial crisis that a weakened economy, if we get to that point, disproportionately penalizes credit quality from the most recent burst of loan growth. We also, unlike 10 or 12 years ago, we're dealing with a different dynamic in the marketplace where now arguably 57% of commercial purpose lending is done by non-insured banks. And that is clearly a different, that's another headwind that, your bankers have to face in terms of looking at legitimate loan growth. So what we're clearly finding in our loan review work is that credit servicing, which is what we mean by that is post-booking oversight and monitoring of credit is struggling. Some of it's resource, some of it's just the carryover from the pandemic where borrowers are being laggards to get current financial information to banks. The original underwriting is as good as it's ever been. It's just the post-booking servicing, which is monitoring performance of your borrower after you book the loan. That just seems to be consistently weak throughout many of the banks we do loan review for. rising consumer debt and delinquencies are now real. They're not theoretical. There's been significant increase and I hasten to say the consumer is really bifurcated between what I consider to be two. One I call the kind of susceptible consumer, which is living paycheck to paycheck, and borrowing heavily on credit cards just to offset the inflationary pressures of living day to day, versus the consumer that is tied to 401ks and has balance sheets that can withstand some of the inflation and higher rates. But those delinquencies are beginning to show up even in some of the community banks, particularly in indirect lending, automobile lending, and so forth. Also, I think commercial bankers, though most concerned, clearly should be about CRE. Charlie Munger, who's a little older than I am, I think at 99, Berkshire Hathaway's, he's Warren Buffett's sidekick at Berkshire Hathaway, and who can argue that they just consistently knock it out of the park from an investment standpoint. He said about 2 or 3 months ago, he said one of his biggest single concerns was, and he used the term, there's some CRE rot in even community bank and regional bank portfolios that he feels like has yet to rear its head. So let's specifically talk a little bit about CRE for a moment. This statistic is staggering to me, because even since the pandemic, community and regional banks, and you look at that top line to the right, is basically increased the exposure to CRE from 17%, and that's including all banks. When it says national banks, that's not OCC banks, that's mega banks. But basically has increased the exposure in CRE since the pandemic from 17% of the total U.S. market to 27%. I mean, that's a staggering increase in exposure to CRE for the community and regional banks, particularly in the face of some of the larger banks and other entities that have pulled back from CRE. I was on a presentation to Illinois bankers just about a month ago and had an excellent presentation by an expert on REITs. And he said, while earnings of REITs were still doing very robustly, he said the discount in terms of the sale of REIT shares has never been greater, because of sophisticated investors are fearing a real problem in the CRE market. Again, these numbers are pretty staggering given the fact that community banks have taken on so much more additional exposure even since the pandemic. Graphs indicating this kind of disproportionate exposure at the communities and regional banks. They're also beginning now to see some delinquency upticks as of June. CMBS, which again is a very sophisticated aspect of CRE, not likely to be seen on community bank balance sheets, but reality is that they're a forerunner in many cases of stress ahead, and clearly delinquencies are showing. Now, we all know the 4 national regulators, the 3 banking and the credit union regulator, joined in late June to issue directives, an interagency kind of warning about their concern, frankly admonishing some of their examiners to not overreact. But basically what they were saying, there was some accommodation that would be given to banks specifically on short-term accommodations, long-term workouts, but all of that had to be rooted in your policy, procedures, and it couldn't be just left to a verbal defense. So there's some, I think, some activity going on in a lot of banks right now in rewriting some policy and updating policies relative to how you would anticipate maybe some stress or workouts or accommodations with CRE loans. Again, not to insult the audience here, but the simplest of CRE metrics is really supply and demand. It really comes down to that, right? The optimal lending territory is when you've got demand that significantly outpaces supply. And I think you're going to have to start making that call within your individual markets around what is either in or out of the supply and demand, or which part of that territory you've lapsed into. I'm speaking literally on Friday at the Wyoming Bankers Association, which of course is in the Mountain West, but here's an example of a slide I'm going to talk about there. This is just three different office property types in CRE: hospitality, office, and multifamily. And I've used markets throughout the entire Mountain West. As you can see, the incredible disparity or amount of variance in terms of where they line up in terms of trending, either downward trending or upward trending momentum in terms of CRE. So each and every one of you are going to have to look at what is the specific market you're in, and not only that, where is your loan portfolio relative to that particular market's momentum around the CRE types that you're looking to. But that kind of gives a flavor, if you will, of what some of the, I think, credit challenges we're facing, that hopefully we can make sure we utilize loan review even more effectively than maybe we've needed to use it in the last decade or so.
Mm-hmm. Yeah, David. And so next I want to ask, what role, or do you think that loan reviews, as you see banks utilizing them now, do you think that they're currently good enough with these trends in mind and with these the way things are looking, and what role do you think that loan reviews should play in preparing banks for the risk environment that we're seeing?
Yeah, this is the real, I think, the heart of this webinar is unfortunately, I don't think that in some cases I think we're still hanging on to kind of the last 10 years of where loan review was just a necessary checklist item. But I think we have to put a lot more focus on what is effective in loan review now. And so unfortunately, I don't think we're at that point in an aggregate way yet. A lot of it is still fixation on larger borrowers. We still get a request by a lot of banks that say, well, just look at the large borrowers. We like you to prep, in effect, to before the regulators come in. We'd like to make sure the loan reviews looked at those. But, again, there are a lot of problems that percolate in smaller relationships that I think, unfortunately, if you don't look at those, you have a problem. Again, scopes sometimes are too small. We've been shocked at some larger financial organizations, particularly, frankly, in the credit union space, where they think that even multi-billion-dollar credit unions can get by with a 25 loan sample for loan review. That's almost ludicrous. Concentrations are not being reflected proportionally. I do think, particularly as it relates to, we know the concentration that I've just alluded to with community banks and CRE, that clearly has to be, I think, a proportional part of your scoping with loan review. And again, I think a lot of what we live with, David, day in and day out at IntelliCredit is really not seeing where banks have been able to acknowledge or perceive where their credit hotspots are. And that's part of our use of our platform as to how we identify those credit hotspots. There does seem to be still a focus a lot on just the risk grade. Hear all the other discussions about it, but as long as you validate my risk grade, I'm not going to worry too much about it. But what we find is that some of the recent loan reviews have shown some credit process weaknesses that I think merit, in the way we tend to deliver loan review, is we not only talk about risk grade validations, we also, try to make recommendations on if there are credit process issues that seem to be percolating. There does seem to be some, believe it or not, some banks that say, well, they're still paying. And as long as they're paying, we're not going to downgrade, or we're not going to consider that a concern. But we all know that can stop quickly. And of course, that puts a lot of focus on the efficacy of global cash flows. There also a sense that, stress tests, if they're done kind of in isolation. They're not done in any way companion with loan reviews, which we're a big fan of. And lastly, I think, and while I certainly understand the human nature of this, of, quote, holding out for a pristine report, it's not really representative in some cases to your board and to management. I think there does need to be an acknowledgement that there are some issues here with exceptions. And, for the worst thing you can have is you're holding out for a pristine loan review, then the regulator come in and find significant issues. So anyway, that's kind of where I think some of the weaknesses currently reside in our current approach to loan review.
Mm-hmm. And so where do you see the improvements being made, and what do you see as a better approach to loan reviews?
Well, I'd start with experienced reviewers. We're a big fan of only using people that have been there, done that, as so to speak. And the real reason for that is they not only get the quantitative part of credit, which is the more mechanistic ratio analysis of credit, but they also get the qualitative, which is the more subjective and often driven largely by experience. Not to disparage some of the larger accounting firms, but some of them send very young CPAs out to do loan review. Again, they get the quantitative, they don't get the qualitative yet. They can't be expected to do that. We only would use and strongly recommend using experienced people to do loan review. Why that's important too is you may need the kind of the power of persuasion to explain to your management team why this credit seems to, so to speak, have hair on it or needs added attention. I think more experienced reviewers can provide that. I just alluded to the fact that there was a lot of problems in credit servicing that's showing up in a lot of documentation or technical document exceptions. Because of that weakness in credit servicing, we are certainly big advocates of having a bifurcated approach to loan review where you would have your technical documents looked at and screened by largely, in effect, paralegals, companioned with the seasoned credit review. It's important, I think, to use smart sampling for your portfolio, understand kind of what is, what, in other words, beyond just the knee-jerk large relationships, what is a reflective of not only your loan portfolio, but also a potential where those credit hotspots. And again, I think it's an obligation of any loan review firm to understand a given bank's DNA. Every bank is idiosyncratic. Every bank has different approaches to lending, obviously with policies and procedures per se, but also just the philosophy of how you work with banks. We were with a large bank on a loan review out west not long ago where the chief credit officer said, well, you know, this is in our policy. And it was largely CRE oriented, but we had to, and he acknowledged, he said, well, we probably need to update our policies because things are changing as we speak in the CRE market. So the other thing is we would say, focus on deliverables. We are big, as we alluded to, in terms of trying to affect some transparency and efficiency and less intrusive experience for the client. But and you do that by what we call the technological platform of real-time transparency. We'll show that to you in just a second. We do segregate. We think you should segregate the pre and post exceptions. We need, as I said, to look at diagnostics on where your trends are in pricing, your vintages, and your concentrations. Under current guidance, of course, now you're mandated to be looking at workout credits, although there are very few of those at this point. And then also make sure your loan review company provides you very comprehensive reports, not just spreadsheets about where they come out with agreeing with or disagreeing with risk grades. We are huge advocates of satisfying that growing need by regulators requesting, if not mandating you to do a stress test. Do that in a companion sense to loan review, and how that can be done is close. It's really kind of emulating, if you will, a sensitivity analysis that many of you would use at the inception of the underwriting process. But the way we would handle that through a loan review is we do a stress component alongside with the normal the scope and sampling, and then extrapolate at the end of the process that stress onto what effect that might be on your risk-based capital. Embrace collaboration. It is critically important to see your loan review as a partner, as an agent of your bank. They're your allies. They're not to be seen, in my opinion, as just an adverse or an adversary in any way, because in some ways, I think they really need to be part of your extended risk management philosophy and treat them that way. Again, collaboration. Of course, that goes both ways. I think it's obligatory for every loan review company as well to conduct themselves in a highly collaborative way. And that's part of the kind of the real time, the transparency, and getting people to understand kind of where the trends are beginning to emerge. And then finally, I think, again, very, very dedicated, I think, in this day and age to embrace technology. So, David, I'm going to change horses on you here. I'm going to ask you a question. Can you give us some examples of how loan review in today's environment can be enhanced by technology?
Yeah, absolutely. So I'll take screen here. But technology can really make the loan review process easier and more informative and thereby actionable. So at IntelliCredit, we have a web-based system that does a number of things, one of which is loan reviews, but portfolio analytics, annual reviews, and so on. But during our reviews, we give our clients access to this loan review dashboard where in real time, all of the reports and exceptions and all of the information about the loan review are made available to those clients. And so you'll see here we have a list of all of the reports that are available, as well as the recommended risk grades. And you click on a report, and here it pulls up the total report. And again, all of this very organized, all available in real time. You see all of the exceptions are listed here, from legal documentation exceptions, credit exceptions, loan policy exceptions, collateral valuation issues, loan booking or approval and structure issues, risk grade changes, underwriting issues, servicing issues, workout plan issues, and so on. Essentially, we, again, give you all of that information in real time in an organized fashion. And it really just makes the reviews very transparent and also very efficient from an exceptions clearing process and report reviewing standpoint as well. Further, in this tool, during the loan reviews, we give you access to our portfolio analytics tool just as a complimentary add-on to the loan review, so that you can take some of these reports about the credit risk within the portfolio and use them again during the loan review. So we have a whole webinar about this analytics tool. But just it's a nice add-on for all of our loan review clients, where as they're in here looking at reports from the loan review and from the exceptions, they can also come in here and look at some of these interesting credit metrics about their specific loan portfolio. And the loan review information even integrates into this analytics tool. So if I open up, if I want to see the last loan review date, let's see here. So last loan review date, I can pull that in, and then I can see the date of the last review here. And then you can even click on this date and pull up the report for that particular loan. So all of it integrates nicely together. So in short, exception can play a very large role in loan reviews in the way we've just discussed, in making them more organized, more transparent, and more efficient.
Great. All right. Well, if you can hand me back the screen, I would certainly appreciate it. And hopefully you can see this screen. Okay. Well, again,
David, you got to share it one more time.
Okay. Sorry. Hopefully you can see it now. Okay.
Yep. We see it.
Super. Well, again, we are hugely advocates of technology. Again, sometimes technology on its own can imply superficiality. What we like to think is blending some of that seasoned review piece with the efficiency of technology is really the way to go today and tomorrow with loan review. Finally, I'd like to say that I think it's critically important to we've said this for many years, almost since the inception of IntelliCredit, is that be able to write your own credit script before others write it for you. I think there's no question that we're going to be faced with a little more aggressive vigilance, if you will, by the regulatory community in the next year or two, largely because of concerns that we've already alluded to in this webinar. But I do think it is incredibly important to embrace the proven axiom, and that is that early detection of credit weaknesses correlates to reduced losses. We certainly think loan review plays a huge role in that. We think, again, using your loan review, the diagnostic credit tools, practical stress testing, companion with the loan review, gives you a lot of a basis to write that script. We've had one client in Nebraska that came to us and said, regulator came in waiving, well, you're 650% of risk-based capital tied into agriculture. Well, he's in the panhandle of Nebraska. That's basically what he can lend to, but he was able to point diagnostically to the fact he had one loan in his ag portfolio that was 15 days or more past due. That's the type of thing that I think all banks, unfortunately, are going to have to be forced into modes of defending their credit performance or the nature of their credit risk profile. Again, you're going to have to do that, I think, before the regulator writes it for you, if you will. But I will conclude by saying the one key thing that you always want to do, and I think loan review plays a very, very important role in this, is you want to evade or not involve yourself with any kind of toxic dynamic of too many credit losses. It's probably the worst dynamic I've seen over my long history in banking between even a board and management team, or certainly between a bank and a regulatory group, to have too many credit surprises. It kind of conjures up either a competency issue or a transparency issue, neither of which would be very positive. So these are the things that we'd like to leave you with. Again, we'd certainly like to be considered for your loan review into 2024. But hopefully you would take this as just kind of best practices. Obviously, for IntelliCredit, we have the third-party loan review engagements, as you can see. But again, we designed intentionally, starting in 2019, we wanted a platform that was could be used for almost any purposes for loan review. We've got clients that use it exclusively for in-house loan review, exclusively. Some that look to us just to co-source some supplemental loan review, what they do primarily to do their own review. We now have an annual review module that can be done and utilized in our platform as well. It is web-based. It's obviously SOC 2, Type 2 compliant. There's absolutely no software integration. We basically are agnostic to your core system. We use the regulatory flat file, the ILDR file, as kind of our energy source. And that way we've kept costs down, and we've certainly made that, again, agnostic to whatever core system you're using. David alluded to this. There will be another webinar that we'll do late in September that will focus more in depth on using IntelliCredit to get at certain data points, particularly as it relates to loan review. But I know there were rave reviews. One of our clients, Zane Smith, Chief Risk Officer for American Bank in Dallas, along with David in early August, did a webinar on how Zane, in effect, uses the tool for discerning certain trends and the so-called hotspots I alluded to earlier. But feel free to watch that as well. Also, which our sister division, Quick Analytics, has been conducting a number of these CECL coffee talks over the last 18 months or so. And that is continuing now that we've got CECL in place. They're still continuing discussion points around how it's interpreted and how you're using it. Obviously, we'll be joined by a dear friend of the Quick Rate family, Paul Allen, a partner in Saltmarsh accounting firm. So any questions that you might have, we'd love to, David, you might be monitoring. Hopefully you're monitoring any kind of chat questions. But again, we're already in 31 states doing loan reviews since 2019, coast to coast. There's no regional focus hardly at all with us. We seem to be meeting, if you will, our goal, which was to give very substantive reviews with enhanced technology, making it more efficient, less intrusive to the client. So again, before we sign off, David, was there any questions or?
Mm-hmm. We had one question about the recording of this webinar, and so the recording of this webinar will be sent to all the participants, and it'll also be available on the Quick Rate YouTube channel. If you just go to YouTube and search for Quick Rate, the same location as the webinar that David was just discussing is currently available.
Yes, and we would also, as I said before, gladly entertain being put in your kind of RFP queue. I know this is kind of the season for next year's loan review engagements. We would love to be asked for a quote and give you some, obviously, a tailored to your scope and desire. We'll have a discussion. We tend to have a little mini demo about how the experience would be at your bank, and then leading very promptly to a proposal for your audit committee or your board to consider. Again, we would love to entertain that. Please reach out to me or to David with the numbers here and the contact information here. And again, we thank you very, very much for your valuable time today on this webinar. And have a good day.